In the last 1 year, the US market has outperformed the Indian stock market by a big margin. This raises a big question. Should you just invest in Indian market or should you also have some exposure to US stock market? If you simply compare India versus US market return in last 1 year, you would surely want to invest in the US market. But that should not be the only criteria because past return do not guarantee future performance. Having said this, one big question you must ask yourself, if your entire portfolio is dependent on one country, one currency and one economy, is that really a diversification? That's where in today's video I want to discuss why it makes sense to have some exposure in the US market. But the catch is, US stock investing is not that straightforward. A lot of people are confused in terms of how do you really invest in the US market from India? How do you transfer money? Which stocks or ETF should you buy? How do you sell? What are the charges? What about taxes? And finally, how do we get the money back to India? In this video, I'll try to answer all these questions. Alright, let's get started. The first question most people ask is very simple. India is growing at a fast rate, our stock market has historically done well, so why do we even need the US market? And that's a fair question. And the answer is diversification and risk management. When you invest only in India, your entire portfolio depends on one economy, one government and one currency, that is the Indian rupee. If anything goes wrong at a macro level, your whole portfolio feels the impact at the same time. US market gives you exposure to a different economy and a different currency, and that reduces the risk. So the first reason to invest in US market is diversification. Do not keep all your eggs in a single basket. It is worth having some exposure in the US market purely from risk management perspective. Now let's look at the return. So when you invest in equity, I assume the investment is for long term. So rather than looking at the last 1 year of performance, it's better to look at the last 5 year and 10 year of performance. So 5 years ago, in December 20, Nifty was at 13,500. Today it is at around 26,000 level. That's more than 90% return. So 1 lakh of investment would have almost doubled. A decent performance. If you look at US market, Nasdaq 100 that represent the top 100 tech companies of US, it was at levels of 12,300 5 years ago. Today it is at around 25,000 level. That's more than 100% return. Now the interesting part is, when you invest in US market, you also get USD to INR appreciation benefit. 5 years ago, 1 USD was worth around 73 rupee. Today it is equivalent to 90 rupee. So you add that return over and above US market return. Effectively the return is around 150%. If you look at the return in last 10 years, Nifty has generated a decent 240% kind of return, but Nasdaq has outperformed Nifty by a big margin with 450% kind of return. Not only that, USD to INR has appreciated from 66 to 90 rupee. So effectively your return in US market in 10 years is around 660%. Then third very important reason to invest in US is opportunity to be a part owner in world's most innovative company. US is home to some of the most innovative companies in the world. Be it Google, Tesla, Nvidia, Apple, Microsoft, Meta, Amazon. These are not just the leader in the US, but these are global leaders. And these companies are shaping what the world will look like 5 years, 10 years, even 20 years from now. Be it AI, advanced robotics, EV, cloud computing, space technology, US is the home of innovation and future technologies. And here is the interesting part. As Indians, we already use these companies every single day. So why not participate in their growth as well as an investor? Now let's discuss how do you invest in the US market. The first step to invest in the US market is convert INR to USD. For that, you need to send money abroad under the Liberalized Remittance Scheme, LRS. Under LRS, any Indian resident can remit up to $250,000 per financial year for purpose like education, travel, investment. So $250,000 is roughly around 2.2 crore, which is a very large amount. Most of us will never ever come close to this limit. So practically LRS is more than sufficient. Earlier this process was painful. It required heavy paperwork, bank visit, then transfer charges of 1,000-2,000 rupee per transaction, and exchange rates were poor. Thankfully this has changed. For my US stock investment, I use IND Money. You just have to sign up and create a free US stock account and complete your digital KYC. IND Money has made this process seamless and digital. Plus, you get competitive exchange rate. For instance, let's say I want to transfer 10,000 rupee. It shows a total amount you will get is $108. You can view the breakup that shows a small GST charge and the money platform fee is 0. The exchange rate shown already includes the forex conversion. This rate is slightly higher than what you see on Google, but that's true for any bank or platform because Google shows the mid-market rate, not the buying rate. Now here is the interesting part. The app clearly shows that you are saving around 1,175 rupee on bank charges and forex fee. Once your money reaches the US, the next obvious question is, how do you actually buy US stocks? The structure is very similar to India. Just like we open a demat and trading account with brokers like Zerodha Grow in India, US stock investing also require a brokerage account. And the money uses a US-based brokerage firm called DriveWealth. DriveWealth is a well-established and regulated brokerage. Many global platforms rely on DriveWealth for executing their international trades. An important point to understand here is ownership. Your stocks are held with DriveWealth that act as a custodian. And the money is essentially the interface that converts your rupee into dollar, routes the money through SBM and gives you a clean app experience. Now you may ask, what if something happens to IND money? Even in that unlikely scenario, your stocks remain completely safe because they are held independently with DriveWealth. You can access your holding, sell your stocks and bring the money back to India. This separation between the platform and the custodian is what makes the system secure. Now let's talk about the actual buying experience. Suppose I have around $88 in my US account and I want to buy, let's say, Alphabet share. When I open the Alphabet page, I can see all the relevant data. 1-day performance, then 3-month trend, then 1-year return and key financial stats. Everything required to make a decision available on my one screen. One big advantage of US stock market is fractional ownership. For instance, one share of Alphabet is $309. That is around 28,000 rupee. Now in India, if one share costs 28,000 rupee and you don't have that much money, you simply cannot buy the stock. In US, that limitation does not exist. You can buy fractions of a share. So even if Alphabet share costs $300, I can still invest my $88 and buy 0.3 unit fraction of that stock. Now let's say I want to buy $10 worth of Alphabet share. So I place the buy order and if the US market is closed, the order gets queued and is automatically executed when the market opens. Once executed, the stock shows up in my dashboard. Now let's say you want to sell your US stock. The process is just as straightforward. You go to the sell option and see exactly how many shares, including fractional shares, you own. You can choose to sell shares worth, let's say, $50, $10 or even less. Fractional selling is allowed, so you are not forced to sell full unit. You place the sell order and just like buying, if the market is closed, the order gets queued and executed automatically when the market opens. In a few clicks, you can be both buyer and a seller. That's the beauty of seamless, well-designed investing system. Now let us discuss a very important question. What should you buy in the US market? Stocks or ETF? Most of us are familiar with big names like Google, Amazon, Apple, Microsoft, Meta. And yes, you can absolutely buy these companies directly if you understand their business and believe in their long-term growth. But the truth is, the US market is far bigger than just a few popular tech stocks. There are many high-quality companies across sectors like technology, healthcare, defense, finance, energy, and consumer brand, many of which are global leaders that don't have any direct equivalent in India. If you enjoy researching businesses, reading financials, and tracking companies closely, then direct stock investing can make sense. But if you want a simpler, more disciplined approach, especially in the beginning, ETFs are a fantastic option. ETFs, that is, exchange traded fund, are US equivalent of Indian ETF. Think of them as a basket of stocks bundled together into one product. Instead of buying one company, you're buying exposure to an entire index or sector that is managed passively. Here you have two options. If you want exposure to the top 100 companies of the US, you can explore Invesco Nasdaq 100 ETF. This ETF tracks the top 100 US companies, essentially some of the best and most powerful businesses in the world. So when you buy Invesco Nasdaq 100 ETF, you automatically become a part owner in companies like Apple, Microsoft, Google, Amazon, Nvidia and many more. However, if you want a little more diversification, you can explore S&P 500 Vanguard ETF. Its ticker is WOO. This ETF tracks the top 500 US companies. For someone who wants exposure to the US market without the headache of stock selection, this is one of the best entry points. You don't need to worry about which company will perform better or worse. You are simply betting on the long-term growth of US economy and its top businesses. ETFs also work extremely well for SIP style investing. You can invest small amount every month, 500 rupee, 1000 rupee or whatever you are comfortable with. This helps you to do dollar cost averaging. So let's say you invest $10 every month into an S&P 500 ETF. In a good month, you might buy fewer units because prices are higher. But during a correction or a temporary crash, that same $10 buys significantly more unit. Over a few years, this creates a much lower average buying price compared to lump sum investing. What makes this even more interesting for Indian investor is the dollar factor. Even if the US market goes sideways for some time, the depreciation of rupee against dollar can still support your returns. So you're not just averaging market risk, you're also building long-term exposure to a stronger global currency. SIP investing also removes the emotion from the equation. You don't panic when market fall and you don't get greedy when market rise. You simply keep investing consistently. This discipline is what creates real wealth over long period, not trying to predict tops and bottoms. For most retail investors, especially those starting out, a monthly SIP into a US ETF is one of the simplest and most stress-free way to participate in the growth of world's largest stock market. You don't need perfect timing, deep expertise, or constant monitoring. Just patience and consistency. Next, let's talk about something that almost everyone worries about before investing outside India: charges and taxes. Because if you don't understand this clearly, you will either overestimate the cost or avoid international investing altogether. Let's talk about charges first. When you invest in US stocks or ETF from India, platforms like IND Money make it super simple and low cost. There are no account opening fee, deposit or withdrawal charges. SIP, AMC and tracking charges are also zero. The main cost comes when you transfer money from India to the US under the Liberalized Remittance Scheme (LRS). Here you pay a forex conversion spread plus GST at a minimal 0.25% brokerage charge. That's it. No hidden charges. Here one important thing to know is TCS, that is tax collected at source. If your total outward remittance under LRS exceed 10 lakh in a financial year, the government collect 20% TCS on the amount above 10 lakh. Sounds scary, but don't worry. TCS is not an extra tax. It's like advanced tax. You can fully adjust it against your income tax liability or claim a refund while filing your ITR. So it affects cash flow temporarily but does not reduce your actual returns. Now let's talk about capital gain, which is actually straightforward. For Indian resident, US stocks and ETFs are taxed only in India, not in the US. So if you sell within 24 months, gains are treated as short-term capital gain and taxed as per your income tax slab. If you hold for more than 24 months, gains are treated as long-term capital gain and taxed at a flat 12.5% plus applicable cess. There is no 1 lakh exemption here like Indian equity. Dividends are slightly different. When US companies pay dividend, US government automatically deducts around 25% withholding tax before it reaches you. This is not double taxation. Mind you, India and US have DTAA, that is Double Taxation Avoidance Agreement. While filing your Indian tax return, you can claim credit for the tax already deducted in the US and only pay the balance tax if applicable. Here one nuisance. If your Indian tax slab is lower than 25%, the credit you can claim is limited to your slab. Finally, there is a mandatory disclosure. If you invest in US stocks or ETF, you must disclose the following holding like your Schedule FA, that is foreign asset, Schedule FSI, that is foreign source income, and Schedule CG, that is capital gain, which is you should include in your ITR. It's a simple reporting, but it is mandatory. You also need Form 67 to claim foreign tax credit if applicable, and you must file ITR 2 and ITR 3. On ID Money, you can easily find all the tax documents and even the automated tax report that makes your US tax filing hassle-free. So the bottom line is this: US investing is not expensive, not illegal, and not tax inefficient if done correctly. Charges are transparent, taxes are clearly defined, and everything is fully compliant. The real risk is keeping all your investment limited to just one country, not taxes or fee. And finally, let's talk about exit. How do you bring your money back to India? So when you decide to sell your US stocks or ETF, the money gets credited to your US brokerage account in dollars. From there, you can transfer it back to your Indian bank account anytime. The dollars are converted into rupee at the prevailing exchange rate and the amount is credited directly to your bank. There's no lock-in period, no special approval, and no restriction on repatriating your own money. The only cost involved while bringing back money are the forex conversion spread. So from entry to exit, the entire process of US investing, putting money in, growing in, and bringing it back is simple, transparent, and fully legal. Once you understand this, international investing stops feeling complicated and starts feeling completely normal. So the real takeaway from this video is simple. US stock market provides a great diversification option for Indian investors. You get exposure to a different economy, a stronger global currency, and some of the most powerful companies in the world, all while sitting in India. You don't need to choose between India and the US. Even a small allocation to the US market done consistently through ETFs or quality stock can significantly improve your long-term risk-adjusted returns. What matters is not timing the US market, but time in the market. Investing steadily, staying disciplined, and letting compounding do its job. And that is in dollar. So if you're looking to start your US investing journey in a simple and compliant way, I personally use IND Money. It handles everything: LRS transfer, currency conversion, US brokerage access, tax statement, and smooth repatriation all in one app. You can start small, invest monthly, and scale up as you get comfortable. If this video helped you understand US investing better, do hit the like button, share it with someone who's still confused about international investing, and let me know in the comment, are you already investing in the US or planning to start now? I'll see you next video. Till then, take care.